Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, investors, traders, money managers, authors, educators, strategists, to pick their brains a bit about how they're approaching the current market environment, some of their lessons learned through their successful careers in the financial industry, what tools and techniques they are bringing to bear to make sense of these market conditions in volatile times. Great conversation today with Callie Cox. Callie's the Chief Market Strategist at Ritholtz Wealth Management. I've known Callie for a while in some of her previous roles, was able to interview her, and I've always found her approach to be super refreshing. She does a great job of cutting through all of the noise, the flurry of information, the fire hose of data that we have access to as investors, and focusing in on key things to look for, key indicators to watch, and just helping us make sense of how the markets are evolving. I love how Callie at one point said, the best way you can manage risk is to know what you own and why you own it. Thought that was wonderful. Maybe realize in a situation like this, with a lot of people questioning market conditions, given tariffs and geopolitical issues, military activity, a lot of question marks about the Fed, about valuations, about earnings. Her comment is just double down on which positions you have and why, and making sure you can justify them based on all of the available information. We also talked about a number of other things. We talked about some of the long-term themes that are driving the technology sector to continue to outperform, things like artificial intelligence, how to balance the challenges of valuations in the short term versus the long-term theme that certainly seems to be a long-term opportunity. Talk about the excessively high amount of money right now parked in money market funds. I think Callie had a great take on why that might be and what that could mean for future risk appetite for investors. We talked a lot about inflation, about the dreaded R words, recession. We talked about earnings. We talked about Fed policy. We talked about government policy. We talked about one-off events or extreme circumstances like COVID and tariffs and other things that seem to come out of nowhere. How to cushion yourself, or at least how to manage the risk of that next event that we don't know about yet, and how it can deteriorate your portfolio's value. We talked a lot, given the conditions in the Middle East, which have evolved quite rapidly here in the last 72 hours. Talked about her latest take based on what we've seen there, how it's impacted the market so far, and what sort of expectations we could have going forward. Overall, I thought this was a great discussion. While we did talk about current market environments, a lot of this was sort of best practices about risk management, about diversification, about identifying good opportunities, about making sure you're not over-concentrated, make sure you're not underappreciating the value of analyzing your portfolio and looking for potential causes for concern. Great investment words of wisdom and great market perspective here today. So please enjoy my conversation with Callie Cox, the Chief Market Strategist at Ritholtz Wealth Management. Super excited to be reconnecting today with Callie Cox. I've known Callie for a while, and I've had a chance to interview her before. Now she's the Chief Market Strategist at Ritholtz Wealth Management. And Callie, great to see you again. Welcome back, and thanks for sharing some time with us today.
Yeah, thanks for having me, Dave. I mean, there's no shortage of stuff to talk about, right?
So I was going to say, you kindly set some thoughts about what to talk about. I feel like our runway, we have plenty of things we can cover here in a limited amount of time. Start us here. I mean, just with the idea of how many different things we have to deal with. I feel like at this point, to be an investor, you have to be an expert in Middle East geography and the Strait of Hormuz and what that means. You have to understand economics, inflation, the Fed, presidential history, and political science. I mean, it's sort of everything. But I think of you as someone who does such a great job of, in the face of all of these things, kind of focusing in and keying in on what's most important and what are like the things we should be following. Can you give us some sense of how, I mean, just in terms of process, how do you actually weed through all of that stuff? And how do you kind of deal with the information overflow I feel like we're all dealing with as investors in 2025?
Well, it's easy, Dave. You just track the tanker volume in the Strait of Hormuz, and that tells you what to do, right?
Anyone
I'm
can
kidding.
do it, right?
Kidding. 100% in jest. I don't do that. It's a delicate balance, right? And I think anybody who's worth their mettle in this business will tell you that it's not about predictions. It's not about being able to look into this mythical crystal ball and see what's coming next. It's just about knowing which risks matter to you and watching those risks. Because the truth is, and Dave, I know you know this, but 90% of the headlines you see probably don't apply to you if you're an investor like me and you're investing years and decades down the road. But that extra 10%, those 10% of headlines that do matter, can be disastrous for your portfolio, especially if you make the wrong decisions if they play out. So I've had a lot of time at Ritholtz and in past roles to really refine how I think about risks. What matters to me, what matters to my clients, what matters to our portfolios, and what is just noise. And I think having that filter is the most important part of being an investor, especially in 2025 when you have all this stuff to think about. I mean, I'd be lying if I said the headlines didn't drive me crazy, because I'm also a human who has a social media feed who, has to keep up with the news because, I can't be an ostrich. I can't just stick my head in the sand.
Yeah.
So, when I think about risks that actually matter, I think about economic crises, economic recessions, which to a degree you can't guess where those are, but there are some clues you can follow to understand how vulnerable the economy is. Policy, Fed policy is one that comes to mind. How responsive the Fed can be if the economy needs help, or, how restrictive the Fed is going to be, if the economy starts growing at a quicker rate, but potentially a rate that spurs too much inflation. Government policy, which is kind of a grab bag. I'm not a political strategist. I can't tell you if the beautiful budget bomb will pass the House or pass the Senate and go back down to the House. But when we have an idea of what that policy looks like, we can anticipate what it can mean for the companies we own and the investments we own. Those are the game changers, right?
Yeah.
Everything else for the most part. And then you have your unexpected events. You have your COVIDs, pandemics, you have wars, things that pop up that you really have no control over. Everything else is noise. We try to control what we can control. And that's kind of how I've developed my framework for thinking about risk over time.
I love that comment. You started off with, we need to have a filter. I feel like we all need a filter, a sanity filter, right? Just to sort of stay level-headed through all of this. But I think that's so well said. And it's so easy to get drawn into stuff that's really noise and not signal, right? And drawn into headlines that seem really important, but at the end of the day, is it really impacting companies' ability to generate earnings? That's the question we probably should be thinking about. You kind of bullet pointed some really good things to hit on. Let's go through a couple of these if we could. You started, just with economic crises, recessionary pressures, just the condition of the economy and where we're at. I'm curious, given the fact and from your work that I followed on social media, you do such a great job of getting thoughts out there. The economic data I would not describe as particularly robust at the moment, right? There are a lot of things to be concerned about. I would not say consumer expectations are particularly rosy. Are you surprised by the resilience of the market and the fact that new all-time highs are not that far, given that backdrop? Is that disconnect? Does that surprise you, I guess, in terms of the strength that we've seen off the April lows and the consistency of that run?
Yeah, it does surprise me. And look, I love seeing higher prices. I read a newsletter called Optimistic Callie. I'm a very optimistic person.
It's such a fantastic name, by the way. That was awesome. Thumbs up.
I can't take credit for it. Josh Brown came up with it.
Oh, that's a good one.
But it does highlight how I think about the world. And if you're an investor and you know about how the U.S. stock market has performed over history, you have to be an optimist. 8% gains since 1950, not consistently, but averaging that over such a long time period is incredible. You blow inflation out of the water. So, really when I try to think about investing, if I'm taking a step back, if I'm summarizing my approach in 30 seconds or less, it's, riding the wave constantly and being able to stay on top of that wave. But, we're in a point in history or a point in the economic cycle where things are clearly wearing down. Hiring is slowing, layoffs are elevated. Luckily the number of unemployed people, I judge that through jobless claims or claims for unemployment benefits, is rising, but not to disastrous levels that you've seen in past crises. But economic data is clearly moving in the wrong direction. And if you go back to those risks, those risks, that 10% of headlines that, could potentially lead to disastrous moves in your portfolio. I mean, a breakdown in the job market is up there. Consumer spending is 70% of GDP. If you're making money, you're spending money. I can confirm that's true, or you're saving or investing it, of course. But the economy runs on Americans' ability to spend, and many Americans make their primary income from their jobs. So, it makes me really nervous, especially because the job market is so central to how I see the economy running. And I'm not sure what turns it around. And look, like I said, I love seeing higher prices. I just don't love that we've seen this strong bounce in the stock market, yet economic data hasn't turned to confirm that bounce that we've seen. I think it's been a mood-driven bounce. The fact that our expectations were set so low around Liberation Day and that extremely worst case scenario didn't happen. But I think at these levels, you have to have some justification for why stocks should be trading at higher prices. We're not seeing it in earnings. Expectations are being cut. We're not seeing an economic momentum. The job market is slowing. We're seeing it in policy, really. And policy is such a wild card that you kind of have to guard yourself against what could come.
No, there's so many great points in there, Callie, to be sure. And it certainly feels, I've built a career off of telling people that the markets are driven by emotion, by fear and greed, and just how people panic in both directions. And I feel like 2025 has been just a perfect example of that in action, where we panic because we think the world's going to end with tariffs. We FOMO this move higher because people are panicked they're going to miss it. And I feel like it's hard to just get a breath and make sense of things. But those indicators that should make us feel really good about this rally have never really materialized. I'm curious. There's still a lot of speculation that a recession we're either in the midst of one and we just haven't confirmed it yet, or that it's right around the corner. But at that point, as we're sort of looking at signs of potential recession, we also have risk assets doing pretty well and continue to push higher. What should investors be thinking about in terms of a potential recession, and how should they be, I guess, thinking about what that could mean for equities going forward? Is that still a very real threat? And what would tell you, listen, despite this move in equities higher, it should not be trusted because of XYZ? Talk to us a little about recessionary fears and how we should be, I guess, objectively thinking about those.
Yeah, so this dynamic is really interesting to me. I think about it a lot because the truth is, and I know you know this, Dave, when we're in a recession, we typically don't know we are. There isn't some big headline that says, today we're in recession. Normally it's this knowledge gathering process where things don't feel so great. We see certain job market metrics break down, or maybe a pandemic hits. There are two types of recessions. There's, kind of trickling into it, and then there's jumping into it. Lately, we've seen the jumping into recessions where we have this big event, and then, wow, suddenly things don't feel so great. We're in a recession. We figure it out a month or two down the road. Here, I feel like we're kind of trickling into it, but even if we're not there yet, the economy is so vulnerable that if another shock comes along, another pandemic, another mind change in policy, another geopolitical conflict, then that could very well be the shock, because the bar is so low for companies to say, okay, I'm done. That was the straw that broke the camel's back. Nobody really knows when that hits. But one thing that I found consistent through history is that the stock market has a really good sniffer for it. If the economy is breaking down, if a recession is on the horizon, especially in those, tiptoeing into recession moments, then typically the stock market will tell you, which I guess you can see as encouraging, because the stock market is telling us everything is fine right now. Right. But usually the stock market peaks a few months before a recession starts and bottoms a few months before a recession ends, which, if you think about it, that tells you that you can't really trust your gut when it comes to investing in the state of the economy. You can't expect that recession headline or that, aha moment where you're like, okay, everything sucks. I got to cut back some of my equity exposure, or okay, everything feels great. Time to get back in. If you're investing like that, then you're probably missing some of the biggest gyrations in the market. So
Mm,
for me, I guess as much as I can, I look at the clues that I know have historically showed us when recession has been around the corner. But I think it's so important to remember that investing isn't black and white. And you can't, to a certain extent, you have to position around your goals. You can't position around these economic turns that you think will happen, because ultimately that's a really tough game to play. And your
yeah.
gut's not going to lead you in the right direction there.
Oh, so many good points in there, Callie. And you're right. I feel like most investors, they sort of expect that there's going to be this such an obvious moment. You fire up, you bring things up like the lights in the room dim, and you're like, okay, now it's okay. Now I need to
Yeah.
change. It's so subtle, right? And I think so many people spend so many times trying to pinpoint a recessionary moment, and it's usually more of a trickle, as you mentioned, right? It's more of an evolution. One of the
Yeah,
charts,
and
if
we
I
could
could,
be there now, and
yeah,
we just haven't really caught on to it. There's also a
yeah.
little bit of like psychological normalization or like bar lowering that goes on too, that I have to be
Mm,
aware of too. I'm like, things are slowing, but then again, it's a mixed picture. It's
yeah.
always a mixed picture. You have
Yeah.
to have some priority in what you're watching, and you have to understand what actually drives the economy forward,
No,
because it's
yeah,
never going to be clear cut.
for sure, for sure. Talk to me a little bit about the Fed. We're sort of in this quiet period, or I guess this pause until the next thing happens. The expectations about when the Fed would, most likely start to lower rates again. That's been moving a little bit. It looks like the September meeting is when the market's at least pricing in a first rate cut. How important would you say, Fed rate cuts are to continuing this bull rally that we've experienced? And what expectations do you have about Fed policy going forward?
I think the Fed has to get to a point where it can act on what's happening.
Hmm.
When I think about the Fed, I mentioned the Fed as one of those risks I watch. Interest rates affect how we think about the world around us, even if we don't acknowledge that or we don't consciously think about that. I mean, if you can get 5% on a savings account, then yeah, you're probably a little more hesitant to put your money into the stock market. I mean, we saw that in 2022 with I bonds while the stock market was going down. I saw that craze. You can't run away. Can't run away from it. But interest rates are like the benchmark that we consider when it comes to where we put our money. It
Hmm.
factors along with inflation, and you have to have a Fed that can respond appropriately to what's going on. I mean, right now the Fed is in a really tricky spot, because if the Fed's two main jobs are promoting max employment and maintaining stable price growth, maintaining stable inflation, then it's looking at pretty high risks on both sides. The job market is weakening. You're not at max employment. You're moving away from that. That's not what the Fed wants to see. But at the same time, we still have so many questions around how tariffs could show up in inflation, because
Yeah.
honestly, we haven't had enough time to see that play out yet. I mean, companies are still. Liberation Day was April 2nd. There was a rush to get ahead of those tariffs, and of course there were a lot of changes on the back of that, but companies are still operating on inventories that they pulled in earlier this year. We don't know who's paying what's ultimately a billion to $1 trillion tax
Yeah.
on somebody down the line: consumers, importers, companies. And there are pros and cons to think about with every step, but ultimately the Fed doesn't know where that ends up. And if chances are the consumer's probably going to eat that, you and I are going to pay that higher bill, and that's going to show up through higher prices. So the Fed
Yeah.
can't do much right now. It knows that if it cuts rates as like a preemptive salve to the labor market, then it could risk inflation catching on. And we know that inflation from 2021 and 2022 is a really hard fire to put out.
Yeah.
You can get it from the supply side, but ultimately, when companies know that they can start raising prices, that's a really hard ball to stop rolling.
Hmm.
So that makes me worried. I'd feel a lot better here if the Fed had that flexibility to step in and balance out the economy more. But it
Yeah.
really doesn't. It goes back to the stagflation word that we hear about all the time:
Hmm.
high inflation, lower growth, like the deepest economic trench you can find yourself in. And I don't say that to sound doomery, because I'm certainly not doomery, but it's important to understand the dynamic that they're working with and this like double bind that they're having to think through.
Yeah.
So I think if we get a rate cut at this moment, it's probably because the job market is screaming for one, and that's not where you want to be, because that means
Right.
we're probably in recession.
So no, really, really good points in there, and I would love to think, if to your point, right? I think that a lot of people assume zero lag between something the Fed does, between tariff policy. We assume like instant, results, right? Like there's a tariff announced, it impacts, and so people immediately were saying, "Oh, it's not that bad." And in my head, I'm thinking, we're not going to know whether anything is, quote unquote, good or bad for quite some time. So having said that, given the lag that we've seen, given the fact that I think you're right, so many companies sort of are working through inventory, maybe in anticipation of the impact of tariffs. Do you think this next earnings reporting, which comes up here in a couple of weeks, sort of mid-July, early August, do you think that's where we maybe start to see the impact? Are we still? I mean, I think, is there a lag that we still could be learning of the impact of tariffs in Q2 earnings, maybe in Q3 earnings? Is that something that maybe stalls this market from the rally that we've seen so far, which basically investors are pricing in no real negative impact of tariffs at this point?
Yeah, I think we learn more about tariffs in this upcoming earnings season than certainly
Yeah,
we did in the last earnings season.
yeah,
I've been encouraged by the amount of earnings growth we've seen. I think in the first quarter it was S&P companies grew profits by 14% year over year, which is historically high. That's a gangbusters or near gangbusters quarter.
pretty good.
But right, and it was way above expectations. I think expectations were for 6 to 7%. So the problem is a lot has changed since then. And what we got out of CEOs' mouths, C-suite's mouths is, we're not sure what the future holds, and we have a lot of these changes that we're trying to work through. And one thing I like to remind people of is that tariffs don't hit every stock equally. I mean, you have certain sectors who supply more from overseas, who rely more on overseas customers. It constantly surprises me that people don't realize that tech has the biggest revenue and cost of goods exposure of any sector in the S&P, any major sector that you can think of. But the AI story and the just general optimism around technological innovation keeps prices high and keeps expectations high. That concerns me, even though, what we've seen in tech has been really compelling and really impressive. But it goes back to, you have to be really careful about where you're putting your money, how spread out it is, because, the risks look different across sectors. And I think this is something that we're going to learn, hopefully not the hard way, but potentially the hard way in Q2 earnings season, when companies kind of have to face the numbers with, tariffs, potential tariff pull through, a potential hit to margins, and a time to update their investors on what could happen for the rest of the year, and, having to kind of mince words around that.
Yeah. Oh, some really good points in there. I'd love to address, I mean, in terms of positioning, one of the things that you highlighted recently, I'm going to bring a chart in here that you shared. The interesting phenomenon right now is, despite the fact that the markets have rallied to the degree that they have, sort of positioning in cash and cash-like items, money market assets, seem to be at extremely high levels. How do we reconcile risk assets rallying with the fact that there appears to be a ton of cash on the sidelines, right? That should be a good thing. I guess that's encouraging at this point.
I think so. By the way,
Yeah.
I know you like hockey puck charts or hockey stick charts. So this is my favorite hockey stick chart right now.
It's a good one. Yeah.
Yeah, I mean, clear hockey stick towards the right.
Yeah.
So I'll put a caveat beside this, because I do think investors are obsessed with cash, especially younger investors, for a few different reasons. One thing you have to remember with this is that there's been a rotation from checking and savings accounts into money markets, partially because we've seen that rate change happen in money markets versus the JP Morgan checking accounts of the world, the bigger bank checking and savings accounts that have stayed at, 0.01% interest rate, because, frankly, those banks don't need to pay out deposit rates to keep money, because they are the big banks. But there's a little bit of a caveat here. I think cash balances overall have grown, but not to the extent that you see on here in money markets. But you have to remember what money markets are, right? They sit in brokerage accounts. They're usually the most accessible cash hoards you have when you're investing in markets. And based on not anecdotal evidence, but like survey evidence I've seen, and a little bit of harder evidence I've seen, there have been signs of investors holding on to cash because we've gotten that 3 to 4% rate for so long, even a 5% rate.
Yeah.
So and I say the royal we, like the investor collective, has been a little underinvested, even though the S&P has had 2 back-to-back 20% years. And, we've just seen so much resilience this year, especially after the Liberation Day turmoil. I mean, I think underallocation is one of the reasons why we've seen such a strong rebound in stocks and, such a rabid risk appetite around IPOs this year and around riskier names. I just think that there's a lot of cash in the system. You kind of see it here, and it's working its way throughout markets. And that's a really hard train to stop. I mean, if you're asking me about reasons to be bullish here, I think the underallocation momentum and the sentiment momentum can be really strong and stay strong for a really long time.
It's so interesting. IPO market is coming back up. SPACs are back. Apparently, we're getting news on that. I mean, that seems encouraging. So risk taking starting to grow a little bit. You'd mentioned when you're listing out your initial bullet points of important things to follow. The last one you mentioned was sort of these unexpected events, right? Like COVID. Tariffs really kind of, although they were, addressed earlier, just sort of the way they were rolled out, obviously pretty exciting events in the Middle East that have accelerated and are pretty volatile. How do you think, or how should investors be protecting themselves? Because I know a lot of people are obviously worried about that next thing we don't know about that's going to hit tomorrow. What do you do today to protect yourself from this unknown and the fact that a one-off event could change the game immediately?
I'm going to give you a basic answer to this, and I think it's the answer that investors need to hear more. I think it's so important to know what you own and know the risks to what you own too. I could go into the whole spiel about owning bonds, owning portfolio protection. I think all of that's important. We can talk about that if you want. But I think for the average investor, understanding what you own, the risks to what you own. So if you own one company, you're exposed to 3 levels of risk. You have sector risk, company risk, and then overall macroeconomic risk.
Yeah.
And mitigating that risk is a really easy step to take without having to pay too much out of your pocket or having to, change the world around this potential black swan or unexpected event that could or could not happen in the next 6 months.
Yeah.
I think rebalancing is really important. Understanding which one of your positions has done really well, and if you need to cut it back because it's, exceeded your target. In fact, we had a client question that made me think about this today. We had a client invest in Circle, which Circle has done incredibly well since it IPO'd. I mean, it's 7 times its IPO price.
Yep.
And there were questions from this client around whether to own it. Is this meme stock territory? What's going on here? And I'm like, look, I think this is where you have to set your expectations a little bit. Why did you invest in Circle? And, did you expect to make this kind of money? And if the answer is no, like this blew even my wildest dreams, then maybe you lock that in and you rotate it out. That doesn't necessarily that doesn't mean that you think Circle is going to zero or you think the crypto industry or the stablecoin industry is doomed. It's just a matter of setting expectations, really. So I think that's one of the most important things an investor can do, especially investors who have positions that are scattered, all across sectors, all across industries. Understanding why you own what you own, setting targets around it, knowing how that connects to your goals. Like if you're investing for retirement, that buffer you have against unexpected events is actually a lot higher than you think. And you can position your portfolio to work in your favor, especially if that unexpected scenario hits and stocks start to fall. And then going from there and understanding where you need to add to your bond exposure, if you need to add some alts or private markets, what you can do to make that strong portfolio even stronger.
Oh, that was a whole 5-minute investment wisdom masterclass there. That was awesome. That was a lot of fun. I love so many things about what you said. Know what you own and why you own it. I mean, that should be a call to arms for most investors that I feel like there's probably parts of their portfolio they should, be reacquainted with and just really think about. The over concentration that happens when you have an AI trade that just all of a sudden gets bigger and bigger and all of a sudden that's your portfolio. Something I found individual investors do not do well enough about recognizing rebalancing and not making your entire portfolio about one name. having a number of ETFs that in the end are making the same bet, and you don't really think about that, right? I mean, those are all just really good, really good points there. I'm curious to wrap up here, Callie. The technology sector has been absolutely dominant. It's been dominating, for much of the last couple of years, but certainly more recently. When you look off of the April lows, very few sectors have just consistently outperformed, but technology is one of those. For investors that have been kind of following this trade higher and feeling probably really good about it, do you see anything, suggesting that they should be hesitant to continue to follow that? Is that still an area where you see strength? What do you do with these names that have just continued to work? I feel like now we're afraid that we've gained too much, and now we're afraid we're going to give it all back. What do we do if we've actually had a pretty good run in technology to date?
Yeah, tech is on a long-term time frame. I think you can't fight tech. I think AI is incredibly compelling. I mean, tech has some of the strongest companies on the market, your Mag 7s of the world, your Apples, your Amazons of the world. If you think about companies that protect you well, if things do go south, if we do hit a recession, your mind kind of goes to quality companies with
sure.
high cash hoards, high competitive advantages. That's tech. I mean, that's big tech right there. Big tech companies are some of the strongest companies on the market. I think where it gets tricky is what's priced into these companies. Is it, profit margins, strong profit margins are priced into these companies for sure. And they've deserved a lot of this, impressive rally that we've seen over the past 10 years. But when those prices move into expectations or dreaming or projections around the AI trade that haven't really been met with, financial strength or profits, which, let's be honest, AI, very compelling story, hasn't led to a lot of profit growth. We're not there yet. The story is too young. But
Right.
You have to realize how much that's played into your tech portfolio and how well these tech stocks have done. Because if we hit a bump, if we hit a recession and investors aren't willing to dream anymore, if they want companies trading closer to their profits, then you probably see money coming out of those tech stocks that do look strong but have traded so far beyond their financial expectations or financial strength that, it's almost like coming back to reality there. There's a center of gravity, and I feel like tech has gone a little too far beyond that.
Yeah.
Does that mean it can push further? Oh, yeah, of course. I can't predict the future. I'm not going to tell you when investors are going to stop dreaming. But going back to protecting yourself in the case of a black swan event or something similar to that, you really have to understand where your portfolio is trading relative to reality and where you can kind of cut those positions that have gone a little further off the map, and not because you don't believe in them anymore, but where you can cut those positions and move them to more value oriented, more reality centered companies or stocks in this situation. I mean, the one thing I'll add too about big tech that I find is really interesting is the fact that they've moved to this like capital intensive business strategy. A lot of spending coming from the Amazon, Apples, and Metas of the world to catch up on the AI front. Actually, I'll take Apple out of that. Apple's not really spending money on the AI front yet.
Yeah.
But a lot of the Mag 7 is spending a lot of money to catch up in this AI arms race. And that's a big change from how they've operated over, the prior 5 years or so. You're not seeing AI turn into profits yet, but you're seeing AI boost expenses and boost spending on the tech front. And I'm curious to see how investors swallow that, because that's a relatively new trend. I'm not sure if investors are going to be so forgiving about Meta saying we're going to come out and spend $100 billion on AI over the next year. And we're going to cut employees at the same time. And, maybe growth is slowing, but you'll love us because we're Meta and we can do it. I don't know how long that works,
That's a compelling pitch right there, right? But you're right. It's so funny. I mean, I've read a lot of books about bubbles and bubble-like phenomena, and it's hard to not think of the amount of money being thrown at AI and the aggressive moves away from reality, and as how you put it. Certainly, there are a lot of similarity. That rhymes a lot with a lot of left side of the bubble kind of activity. And that doesn't mean that theme can't work remarkably well for years and decades down the road. But the question is how far do valuations get before you realize that we're pricing in some sort of crazy reality that may not actually play out. I think that's really well said, Callie, for sure. This is a lot of fun. I wish we could go on for hours. I'm going to be very thankful that we had this time together. Well, I will accept your offer to come back on the show. I hope very soon we can continue the conversation, see how some of these things have played out later in the year. But for now, I'll say thanks so much, Callie, for giving us some time today, and I wish you well as always.
Yeah, thanks for having me, and stay optimistic. That's the only stance you can take if you're long term, and many of us are long term.
When in doubt, let's stay optimistic. Thanks again, Callie.
Yeah, thanks.
It was a great interview with Callie Cox. I really love how she said that. Know what you own and why you own it. What a great exercise. And that's something we used to do with portfolio managers. When I worked at a large money management firm, we would do a portfolio review. And I found just the practice of having someone else review your portfolio and basically look at some things and say, hey, what's that position right there? Let's talk about what that is and why you still think it's a good idea. And just that simple process of having to explain to someone else why you own something, all of a sudden you would maybe struggle to justify it. And in your head somewhere you're like, ooh, maybe I shouldn't have that position anymore. And you kind of knew it, but until someone points it out, it's kind of tough to acknowledge that. I really think that exercise of a regular portfolio review, really looking at all of your positions, what bets you're making and why. I find a lot of times individual investors sort of don't have enough of an understanding, really haven't done a deep portfolio analysis to think about their bets they're making through stocks, ETFs, what other positions that they own. So I hope that's a takeaway, something you can dedicate some time to here this week, perhaps. Love Callie's comments about the money market funds. And again, I think the point we got to, we kind of ran out of time to dig a little deeper in there, but I think that point of, I know for me, there are certain accounts where you are put in a sweep account with like a 0% interest or 0.01%, or you can put it into a money market fund where you're getting like 4 or 5%. It's obviously a much better place to be. And I think that the discrepancy right now is causing a lot of investors to go into money market funds, but that's a lot of money in cash as we're getting and getting near all-time highs on the S&P 500. I think that was her point, which was very well taken. Loved our discussions about recession. I think her way of describing what that might mean, how that could work, and what kind of things you can look at now to protect yourself, I thought was really valuable. Really appreciate her comments about technology, being careful that you don't get over-concentrated in particular bets, making sure you understand the long-term potential of things like artificial intelligence, but also how to navigate some of those short-term periods where the markets can get very far away from the fundamental valuations that may make sense, even if the long-term story is going to work. At some point, overvaluations can often be a quite painful revaluing coming later. Overall, great conversation with Callie Cox. Look forward to having her back on the show later this year as more market conditions evolve. We can see how things have changed since this most recent conversation. But I hope you found those were some great words of wisdom, which I thought were really well said. By the way, if you want to learn more about some of the tools and techniques we alluded to in terms of how you can understand the markets from a technical perspective and recognize the difference between the charts and the technical valuations versus the fundamental valuations, our Market Misbehavior Premium memberships may be a really good opportunity for you to improve your own market awareness. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses like Flight School Behavioral Investing, where we teach you about behavioral finance, what happens between our ears as investors, and technical analysis, a set of tools we can use to evaluate the world around us as investors. Second benefit would be all of our members-only reports like our weekly flight plan, our main report we put out every weekend, where we look back at the week that just happened. What was new, what was important, what was different. We look forward at the week to come. What levels, patterns, and signals should you be watching for to navigate these markets? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community. That is a place filled with like-minded investors navigating these markets using these tools and techniques. You can see how other people are trying to navigate them, navigate the markets, look at what charts and tickers they're asking about. You can ask your own questions. I'm in there every day answering questions from our premium members about different technical indicators, specific charts where they have questions and just general market conditions and anything and everything else. Great community, a supportive community of investors navigating these markets using the tools of technical analysis. Would love to have you on board as well. If you want to learn more about the premium memberships, just go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, my name is Dave Keller, reminding you it is always a good time to own good charts.